Kia ora, e mihi ana kia koutou. Welcome everybody. My name is Josh Roach and I'm the country head for Marsh in New Zealand, and welcome to all of our clients and all of our colleagues from around Marsh, Aotearoa, and thanks for joining our Marsh New Zealand insurance market update. I think today's session is actually particularly timely when you start to consider the vast array of macro themes and conditions that we're starting to see right now. If you sort of turn your mind back to the most recent reporting season, all the global insurers have posted very strong underwriting results and combined ratios, I think at the best that we've seen now in 4 or 5 years or so, and John Donnelly will take us through that very shortly. But when you think about that, probably using the excuse of lack of profitability to dictate terms and conditions probably just isn't acceptable anymore. You then only need to turn your attention to the events happening in northern New South Wales and Queensland and the flooding situation there, really just to bring you back home, just to make us realise just how vulnerable we are to natural catastrophe hazards. And so we can plan for, we can mitigate, we can transfer risk as best we can. But at the end of the day, these very large and unanticipated catastrophe losses are completely outside of our control. The Wellington insurance market certainly does continue to evolve in 2022, and I'm sure there's a number of you on the webinar today interested to unpack the earthquake capacity situation resulting from Wellington, and so we'll certainly touch on that in more detail a bit later on today. And the financial lines and the cyber market do continue to remain a challenge. And look, for me personally, the cyber market is definitely top of mind. You only need to consider the events that are currently unfolding between Russia and the Ukraine. I think that war in itself is keeping many of us on our toes. We know that it's keeping the insurance market, the cyber insurance market, on its toes. And sitting here right now, thankfully, we haven't seen or yet experienced a sort of a large scale cyber event emerging from that war, but we certainly know that the Kremlin and Russian military hackers, they have the wherewithal to deploy very large and very serious cyber attacks as well. On a more positive note, the health and benefits and life markets, as well as the general liability markets, are certainly showing signs of stability. Joining me today, we've brought together a very esteemed panel of colleagues, including John Donnelly, who's the head of placement for both the Asia and Pacific regions for Marsh. We have Justin Armagnac, who's the head of placement for Marsh in New Zealand. Also joined by Nigel Grantham, who's the chairman of our specialty practice based here in Auckland. Phil Broomhead will take us through people risk insights, and Phil is a placement leader for our Mercer Marsh Benefits business. And finally, John O'Sue will join us to talk us through the cyber market, and John O leads our cyber specialty for Marsh in New Zealand. When we get around to the Q&A, we'll also be joined by Donald Gardner, who leads our construction specialty, and also Mark Beale, who leads our marine specialty as well. And so if you've got any questions at all covering any of the topics that we're addressing today, including construction and marine, please do feel free to jump in and use the Q&A functionality in Zoom, and we'll do our best to get to those questions at the end of the session. So we've sort of got roughly 40-45 minutes of content, and we'll make sure that we leave plenty of time for questions at the end. Okay, on that note, I'm going to pause and pass the floor to John Donnelly. Over to you, John.
Thanks, Josh, and good morning, everybody. Pleasure to be joining you today. I'm going to spend just a few minutes talking about what's happening globally in the insurance market, what's driving the current conditions, and I guess importantly for you, the clients, where we see the market going throughout 2022. Could I have the first slide, please? I should say at the outset that I've been quite bullish on the market since late last year, and started this year with a great deal of optimism on where pricing might be heading. My optimism has been dampened by the flood events that we've had in Australia in the last few weeks that Josh alluded to. which have spread from southeast Queensland through northern New South Wales and down into Sydney. And we have a tremendous number of commercial client losses and some very, very large losses. It's unquestionably going to result in the largest ever single event loss that the Australian insurance market has suffered. And whilst that should not directly impact the New Zealand market, it does just add another catastrophe event to the major reinsurers. And it's a bit of a theme I think you'll hear today that catastrophe capacity is already in decline, and this event here isn't going to help. So we'll talk about that in some detail today. So the first graph you're seeing there represents the global pricing trend on the business that Marsh trades on behalf of its clients throughout the world. It's all major classes combined and all geographies combined. So the peak of the increases was Q4 of 2020. That was at 22%. And we are off 30% of that peak at the end of 2021. And I think the trend for Q1 of 2022 will be positive and downward further. Next slide, thank you. So here are those numbers by region. The UK have been for some time, are the leaders. Unfortunately, we in the Pacific are a clear second. We were the leaders. This is just showing the 2021 numbers. In the prior 3 years in the Pacific, we were the leaders. The UK have overtaken us mainly on the back of financial lines pricing increases. Property was the big driver in our region, but fortunately for us that with the exception of the major cat exposed risks, the property increases have come down to single digit numbers. So all positive there. Next slide, thank you. This shows the increase by line of coverage. In 2021, it also shows a global downward trend for each of the lines of business. You'll see that the FinPro has the biggest increases by far, and this is historically been driven by listed company D&O class actions, which were resulting in huge losses for insurers. The D&O market, and I'm sure you'll hear this a bit later, has stabilised somewhat. Pricing has reached, for insurers, sustainable levels. And as a result of that, some new capacity has entered into the market, mainly in London, 6 or 7 new insurers bringing capacity to the market. But those FinPro numbers you see there, they're being inflated now by cyber and the increases in cyber. We have historically reported cyber in the FinPro numbers. We won't be doing that in the future as a result of this distortion, and it will be reported standalone. In the US and the UK, we're seeing triple-digit increases in cyber premiums. And in our part of the world, we're experiencing a dramatic loss of capacity and substantial premium increases. Next slide, thanks. Josh talked in the opening about the insurers making money, and these are the 7 or so major global insurers where we trade business on behalf of clients. We track their combined ratio. So the combined ratio, just to explain, is really the true measurement of an insurer's profitability. It is claims plus their expenses represented as a percentage of premiums received. So if the claims and expenses are more than 100% of the premiums received, they're obviously losing money. So take yourself back to 2017. Every insurer, with the exception of Chubb, was losing money, mostly so in 2018. Chubb is a sort of theme here all the way through that they've never been in a losing position. But if we take 2021, everybody has produced, by their own standards, a stellar result and a great improvement on the previous year. And the previous year's numbers were inflated by COVID. So we was telling the market that they were making money and at rating adequacy in 2020, but along came COVID and the insurers put away pretty significant reserves to cover COVID losses. We're now seeing them release some of those reserves because the losses haven't come to be. But just to pick a couple of across that line in 2021, Swiss Re at Corporate Solutions at 90.6%. They've been in business for 14 years, and this is the first time in that 14 years that they have actually made money, that they've got the combined ratio below 100. AIG at 92.4. This is their best result since the GFC, so about 2008. And Zurich at 94.3 is their best result since best result in the last 15 years. So, the market is in pretty good shape. The profitability is there, and we are pushing the carriers very hard to recognise our clients and the contribution they've made to that correcting of the insurers' results, and asking that reflects in renewal pricing. So they're at a decent premium level. They call it rating adequacy. And this is why we remain quite bullish on pricing. And we're hopeful that sometime in 2022 that we're going to see pricing start to move in a southerly direction and get some pricing relief for clients. Unfortunately, the market's appetite for catastrophe risk, and if we move to the next slide, has not increased. There is no increase in appetite for catastrophe risk. In fact, it's reducing. And Evan Greenberg, the chairman and CEO of Chubb, in their recent results announcement, he said that the less catastrophe business I write, the more money I make. And unfortunately, this is a sentiment that's sort of permeated the whole industry. I'm sure Jason's going to refer the impacts in New Zealand there, and Josh did in the opening. But there are major issues in relation all throughout the world. Wind issues in Florida, earthquake issues in Tokyo, and I don't doubt in Brisbane and Sydney, we're going to have serious issues with the flood risk in upcoming renewals. No major insurers accepting more catastrophe risk, no new capitals coming to the market. And this slide here is actually produced by Guy Carpenter, our sister company, the reinsurance broker, where they track the rates of catastrophe premiums that reinsurers charge their insurers. That's over the last 30 years. And you can see that we are still not at the levels or the peaks that existed in the early 90s and 2005 and so, following major catastrophes at those periods of time. They were both major hurricane seasons in the US. So we are still on an upward swing. And we expect that as a standalone catastrophe risk is going to become more difficult to buy through 2022 and into 2023 than it has been even in the recent years. So just to wrap up the global view, the market is in the best shape from a profitability perspective that it's been in for many, many years. This should mean stability in pricing, and it should mean stability in capacity, with a fairly short-term and eventual improvement in pricing for clients. The two areas of caution, of course, catastrophe, which we seem to be labouring the point on, and cyber, which Josh referenced in his opening, and I'm sure Jono's going to talk in a lot of detail during this presentation. So that's enough from me. Justin is going to now run you into the property element of the market in a lot more detail than I have. So thanks.
Thank you, John. Good afternoon, everyone. Introduction again, my name is Justin Armanack. I am the placement leader for Marsh in New Zealand, and today I will focus on property insurance market and the unique challenges that buyers in New Zealand will face in 2022. Look, many of the trends that we are seeing in the global market that John has just mentioned are definitely cascading down here into New Zealand. Stability is returning. The magnitude of rate increases is reducing. We've seen that now for a few years running, but nonetheless, they are still rate increases. So whilst many carriers are starting to turn a profit in this most recent financial year, the true test for them will be doing it consecutively. And so there is going to be underlying price pressure again throughout 2022, just not to that same magnitude as we've seen in the past. Now, a lot of this this underlying price pressure is related to two key factors. The first is increased reinsurance costs, and the second is inflationary pressures. When we talk about increased reinsurance costs, this is driven predominantly by the more frequent and more severe weather events, already we've mentioned. Here in New Zealand, we've certainly not been immune over the past 12 months. You think back over throughout 2021, we had Canterbury flooding in May. We had a tornado come through South Auckland in June, and then 2 more flooding events in the second half of the year, one in Westport in July, and then another one in Gisborne in November. And all of these do go and erode away the profitability of insurers. The inflationary part of this is certainly around claims costs. It's, as with anyone that's been trying to operate in the construction sector in the past 12 months has definitely seen there's a constrained supply of materials therefore are costing more, and there's a limited labour market supply as well. And so that all starts to group up and cause increased inflationary pressure on claims costs for insurers. And so they're factoring that into their pricing this year and driving rate increases still. The New Zealand property insurance market, therefore, is going to remain hard for all buyers throughout 2022, but particularly where the insured is involved in high hazard occupancies such as waste recycling or waste management, chemicals, and also in the power and energy space. Any client that utilises or occupies buildings or cold storage facilities that are constructed in expanded polystyrene panel or EPS as it's better known, they will continue to feel capacity and pricing squeeze also. Now, these are industries and sectors that have been the predominant contributor to fire and machinery breakdown losses over the past decade. And therefore, that's resulting in more determined underwriting action in these sectors. We also anticipate that the overall underwriting process and turnaround time for negotiating renewals this year will continue to be slow due to factors that we typically see through a hard market. Things like a high degree of referral underwriting taking place. So this is where insurers need to go and make a referral to their head office in order to get the necessary approvals that are required to confirm their terms. It's just an extra link in the chain that takes time. Many insurers are still undertaking policy coverage reviews, and this continues to be a focus during the fallout from the pandemic, as many silent covers are being explored and insurers are looking to make certain around the words and the intent of the cover that they provide. In particular, we've seen this in the business interruption space around extensions such as customers and suppliers, prevention of access, and port blockage. These will remain a focus. However, much of the change in this space has already been completed, so it will just be mopping up the last few accounts that may not have had that change come through. We continue to see technical premium rate benchmarking. Insurers are ensuring that on a case-by-case basis, they are meeting their allocated costs for treaty, for overhead costs, and making sure that it's all accounted for in a pricing model. And then the final factor is just late reinsurer capacity. Many insurers rely on reinsurance support to be able to provide the cover that our clients enjoy. But often we are seeing through this market cycle that insurers delay offering those terms in an effort to position themselves for the most advantageous outcome for themselves. And so that, again, just prolongs the negotiation. Our guidance to clients is to start the process, the renewal process, as early as possible to ensure that delays are anticipated and contingencies are set for a protracted negotiation period. To generalise though, the New Zealand property insurance market in 2022 will continue to operate at 2 speeds based on geography. Customers with assets in Wellington are going to continue to encounter the greatest challenges than the rest of the country. Whilst this circumstance probably isn't new, the underlying dynamics of the Wellington market are continuing to evolve, and 2022 is now certainly at a tipping point. And it's this dynamic that I really want to stress today, because the ability to insure Wellington assets in the same manner as we traditionally have is now starting to come to an end. The amount of aggregate or capacity that insurers are able to deploy for high-risk regions such as Wellington is finite. In the aftermath of the Kaikoura earthquakes, we all encountered insurers taking remediatory action on their portfolios. They reduced the amount of aggregate they were deploying in Wellington, and that they ensured that they achieved a ratio of Wellington exposure to rest of New Zealand exposure that gave them a desired sort of balance within their portfolio. Much of this rebalancing was completed back in 2019, and insurers since then have been prepared to accept growth in their Wellington values, provided that they achieved the rest of New Zealand exposure grew at the same rate. So making sure that they just kept the same sort of proportions of Wellington to rest of New Zealand. For most New Zealand insurers, this rule still applies. All right, they have sufficient headroom for growth. And this is growth which is inevitable this year through valuations uplift that is being driven by inflationary factors. However, for New Zealand's largest insurance carrier, IAG, which is home to brands here in New Zealand such as NZI, AMI, and State, the situation is quite different. They've recently topped out the maximum amount of aggregate that they can deploy in the Wellington region. For them, it's not a question of portfolio balance any longer. It's quite simply that they have no more to give in Wellington. And this is significant because it heralds a long-term shift in the marketplace. If you're a Wellington insurance buyer and a customer of IAG or NZI, what you probably need to start to expect initially is that IAG need to start to create some headroom within that Wellington portfolio to support the inevitable growth that they will see through exposure to valuations growth. Now, they won't be creating this headroom through the purchase of more reinsurance protection. Rather, what they're going to do is they're going to start to reduce their line size or share of accounts. They will look to reduce the cover that they offer through lowering policy limits or reducing indemnity periods. And in some cases, they may even decide to exit business entirely and not offer renewal to some customers. Inevitably, that's not just going to have an impact on customers of NZI, but it's going to have an impact on all Wellington insurance buyers in some way. This is a significant change in that marketplace. The availability of Wellington aggregate is now becoming more scarce, and this change suggests that there is no longer sufficient supply in the market to meet demand, at least at current prices. So there might be some new supply that will exist out there to a degree, but it will come at more opportunistic or higher rates than currently experienced. Surplus markets such as London and Singapore won't compete with our local New Zealand carriers on price. They will hold out for their technical cost of capacity. And unavoidably, pricing pressures will continue and rates will rise again in the Wellington region for property owners this year. More importantly, though, and reason really to take notice is that the Wellington market is now moving into an unenviable list of constrained geographies for catastrophe perils. Those that have purchased insurance further abroad globally will know that certain areas such as Dutch flood, Florida windstorm, California earthquake, and even North Queensland cyclone are all geographies and perils where capacity is severely limited, to a point that clients with assets in those locations are unable to access sufficient capacity just to cover their probable maximum loss scenarios. Wellington earthquake perhaps isn't on that list quite yet, but inevitably it soon will be, as exposures will continue to grow in that region, but capacity won't. So how are we helping our clients manage through this? First and foremost, and I can't stress enough that this isn't a short-term issue, all right? This is a turning of a tide and the effects will be long-lasting. Purchasing ability really has changed here. And there's going to be two immediate ramifications of the change. Firstly, there is going to be a need to find new capacity, both near and afar for many customers. And then secondly, there's going to be a need to quantify Wellington exposures in an effort for clients to set out appropriate policy loss limits, right? Marsh have the best people and resources to assist clients through this transition in the market. Our client executives work very closely with our placement team in sourcing capacity solutions, both locally and internationally, utilising our global broking network. Our advisory business have capability in valuations, loss control, risk engineering, and natural catastrophe modelling to help quantify exposures and provide clients confidence in setting loss limits. The fundamentals of any successful renewal strategy will still remain though. Commence discussions with your broker early and arm yourselves with good data and analysis. Insurance valuations in particular this year are going to be absolutely necessary to avoid punitive renewal terms. So in summary, the property insurance market here in New Zealand continues to stabilise. I know that a lot of what I said sounds quite negative, but for most insurers outside of Wellington, they're going to see better results this year on their renewals than they have in previous. But however, for Wellington purchasers, the challenge is going to be quantifying exposure this year, purchasing only what is necessary in order to make the most efficient transfer of risk. I'll be happy to take questions at the end, but I will now pass to Nigel to discuss financial lines and liability. Nigel, are you there?
Hello, you there?
Perfect.
Okay, hi. Kia ora, everyone. My name is Nigel Grantham. I'm chairman of Marsh Specialty. Within that comes the FinPro Lines, which is an acronym for Financial and Professional Risk. And today my address will talk about D&O, Professional Indemnity and General Liability. And moving to the Directors and Officers Liability, I just want to segment out the D&O landscape because it does differ quite markedly depending on where you sit. Just starting off with dual listed companies, we are starting to see some rate moderation compared to previous years. And when I say rate moderation, the momentum over the last few years has been quite epic, very large increases in dual listed companies, especially if you are buying side C cover. However, some positive news and optimism. Local market is paring capacity and pulling back a bit on that, but London is starting to show signs of increased capacity, and to John's comment earlier, there is 5 or 6 new markets coming in. It's the classic insurance market cycle where capital is looking for some investment and returns in very low interest rate environments, and they've looked at the D&O market, and there seems to be obviously some enthusiasm around writing D&O business, and they're starting to show their worth in that area. And that's good news because you need to have some momentum coming in from somewhere to start changing the minds of underwriters who are or have over the last 3 years come under an assumption that they can continue to increase pricing because no one else is actually challenging that. So that's very positive news. We see that continuing through 2022. A couple of things on emphasis on critical is cyber and ESG. ESG is an evolving situation, and many people are saying, well, what does that mean to us and how do we deal with it? And Marsh will be able to provide some advisory services around that, and we'll be discussing that along with cyber and various other issues around in the pre-renewal meetings that we have with you. Another bit of positive news, there's now some wording stability. We're not looking and seeing increasing restrictions or exclusions of coverage. And that's really just perhaps some of the changing market dynamics that we're seeing today. Moving to the NZX listed companies, with the same theme, there is rate moderation. We have very little capacity restraints locally, especially if companies are only buying, taking side A and B. But I think the underwriters or insurers locally have taken advantage of the increase in pricing over in Australia, and they've ridden that wave quite successfully. The New Zealand market is relatively benign. There have been some matters that have occurred and quite large D&O losses, but they're relatively historic. So we're now starting to push back on insurers looking to increase pricing for the renewals. Then we move to the non-listed companies or not-for-profit organisations. If you've got good financials, and that's really the same for dual-listed and NZX-listed companies, but good financials, we're very hopeful that we can agree flat to an increase in inflation increase, which currently looking around 5 to 6%. But look, the forward-looking guidance is still uncertain. The impact of geopolitical risk, the conflict in Ukraine and there's other flashpoint areas around the globe may affect liquidity and capacity. That's yet to be realised. Inflation is rearing its head. It's all throughout the world now. We're not immune from that. The effects of COVID still haven't really come through. 2022 could be a very pivotal year as the government stimulus sort of reduces or ends and the true effect of company results come through. And of course, the Reserve Bank increasing interest rates and the impact that that's having on borrowings. I would say that insurers' response over the last 2 to 3 years has been very slow, almost anemic. The key issues here are that it also actually stops questions coming back from the insurance market and therefore encompassing delays. Next slide, please. Now, quite a myriad of other issues to deal with in respect of risk governance. And one might say, why would you be a director when you are confronted with all these issues here? So it's a challenging environment. And of course, if you're a director, you can make a difference. Moving through to the PI. So in professional indemnity, once again, generally there's rate moderation for most professions who have good claims experience. Once again, the PI market is relatively stable in New Zealand, but reinsurance costs are increasing, and we are resisting the efforts of insurers to hand on or place those costs through to the consumer. There's major challenges in the construction sector. It's very distressed in the contractor and consultant areas. For instance, project-specific covers, 10-year policies are proving extremely difficult to place, and the costs of those are starting to turn into what we call a constructive declinature, where the price is so high it's not worth taking the risk or paying the insurance premiums. There is the hope that the wording stability is pretty good. We're not seeing too many changes with the wording, except one area now, the affirmative cyber exclusion. Now, to explain that, in the UK, the Prudential Regulatory Authority imposed a mandate around the cyber exclusions going on to PI policies. And they did that because they were worried about the aggregation of risk, where a cyber claim could be claimed under a PI policy just through the wording of the PI cover. And so that all quotes coming out of London will have a cyber exclusion. It's not the end of the world, because it needs to be as a pure cyber event, not any intervening situation where a client has provided advice and then a cyber attack has hindered their advice. But it does lend itself to in the situation is that the New Zealand market haven't been applying these affirmative cyber exclusions, and we will see those coming in during 2022, our view. Claims are tending to take longer to settle. COVID hasn't helped that, of course, with the courts being delayed in respect of hearings, and claims inflation is starting to be a consideration for insurers when they are pricing up their risk. Once again, the same themes apply in respect of the uncertainty around increases. And in respect of clean risks, if there has been a revenue increase, then they'll look to increase the premium in a linear fashion as it relates to the increase in your revenue. So we need to resist that. General liability, the outlook is much greater stability than the PI and D&O over the last few years, but there have been increases in pricing just through a price for the capacity that's been available. We believe the remediation has been achieved and that we're likely to only see requests for inflationary increases where there has been a benign claims experience for the client. Moving on to final thoughts. So we've seen in the last 3 years significant price increases. It's about time that we the market has realised that the remediation is done. As I said, they need some encouragement, and that's coming out of London in some areas. The insurers' combined operating ratios now, we always talk in insurance acronyms, but the combined operating ratio is the premium received by the insurer less the claims outturn and reserves that they have posted and their operating expenses. And if it's below 100%, then they're making an underwriting profit. If it's above that, they're making an underwriting loss. In today's environment, they're not making much on their interest for their earnings. So those CORs for the financial lines insurers are looking very positive. To John's point, he showed earlier on the FinPro results there, and those are good ammunition for us to go in and say, well, enough's enough. We think you need to moderate completely those increases coming through for good, clean risks. But just as a warning, further black swan events we can't predict. Another pandemic or escalation of the conflict in Ukraine may have some spillover effects in respect of those areas of insurances. And now I'll hand you over to Phil.
Thank you, Nigel. So my name is Phil Broomhead. I'm the Marsh Benefits New Zealand placement leader. So today I'll be providing commentary on 4 topics. Firstly, the life and disability market, then looking at health insurance, then moving on to just a new concept and new way for employers to be looking at their people risk management. And then finally, the proposed New Zealand income insurance scheme, which many of you will have heard about. So just sort of focusing in on life and disability, overall, we're seeing that life and disability rates are increasing when the premium rates are reviewed, which is typically every 3 years for employer-sponsored plans. And on average, that's around sort of the 6% increase, depending on the claims experience of the plan. Looking at the claims statistics, we are seeing the cancer rates are on the increase. 1/3 of all deaths in New Zealand is caused by cancer, although there is some evidence that for critical illness conditions such as cancer, that those claims have decreased during the pandemic as routine tests and scans haven't been happening as frequently, so the detection of those conditions hasn't happened. Mental health is also a really big cause of concern for insurers, and it's causing an increase in the long-term disability claims. So with those claims, early intervention and claims management is crucial to the successful rehabilitation of those claimants. And whilst there are no exclusions of COVID on life and disability policies, the unknown at this time is really on the impact of long COVID going forward. Just moving on to the next slide, looking at health insurance. The Financial Services Council has released their latest health insurance data report, which has stated that 30,000 more New Zealanders have taken up health insurance since the start of the pandemic. They also highlighted a recent increase in health insurance as an employee benefit, which is due to the tight talent market and employers competing for that talent. In certain sectors such as IT, comprehensive employee benefits, which including health insurance, are now very much the norm, and that wasn't the case several years ago. That aligns with the Mercer UK latest research, which shows that 9 in 10 organisations have changed their benefits in response to COVID-19, with 4 in 10 increasing the core benefits and 8 in 10 introducing a new wellbeing offering. Medical premiums, though, are increasing, and typically we're seeing increases of between 8 and 12%, which is in line with medical inflation, although this could increase further with CPI increases. That said, we are seeing some increases coming through depending on the claims experience of 20% or so. Collective pay agreements with nurses are anticipated to have an impact this month. And one impact of COVID is that, again, the delays in procedures making it difficult for insurers to predict future claims and what the next year or so is going to look like. We are continuing to see a shift by clients from having the schemes managed directly with insurers to having an intermediated relationship where advisors, such as Marsh Benefits, can provide improved governance and look at data and analytics to provide some strategic advice around cost containment. As with medical procedures, ACC claims have declined as well, and that's due to employees working from home. However, as we go through a return to the workplace, it's anticipated the claims will increase to levels which were seen pre-pandemic. Health and safety managers in the workplace are currently prioritising safe workplace practices with the spread of Omicron and the use of rats. So just moving on to the next slide. In our experience, we believe that there is a real opportunity for businesses to change the focus of people risk management by firstly taking a more strategic approach and investing time and effort in keeping employees well, safe and productive through understanding what's really driving the risk and then the employer putting in place targeted initiatives to address and mitigate that risk. By doing that, organisations are going to contain increasing costs. They're going to reduce absenteeism and minimise the impact of the ill health, which is shown there below the line. We do see many companies spending a lot of effort in focusing on managing just one of those quadrants without making a connection to the others. So particularly when it comes to insurance or self-insurance, efforts spent on the design, the process, the providers and financing, which are all below the line, without too much thought about how to manage the risk of injury or illness, which lead to those insurance claims. Our team's got the capability to support clients in taking a more holistic approach and view of the way that they understand and manage the impact of ill health and injury, which creates a better balance and keeps both the employees and the employer's business healthy and protected. So finally, just moving on to the next slide, many people would have seen the recent proposals for a New Zealand income insurance scheme. It's basically an extension of ACC to provide an income insurance scheme that covers illness and redundancy for a period of 7 months. So it's extending that sort of the current ACC disability benefit. It's currently under consultation, but it could be introduced later on this year and commence in 2023. The proposal will mean that employees and employers will both pay a flat levy of 1.39% for the scheme. Our view is that generally, whilst providing a compulsory insurance scheme for employees who don't currently have insurance, or maybe they're potentially uninsurable, could be seen as positive, many employers can and do actually provide benefits that are better than the proposed scheme and for a lower cost. So we would support the opportunity for employers to participate in something similar to the current Accredited Employer Programme, or AEP, which they can currently with ACC, and that would allow them to outsource the claims management and rehabilitation and provide a way to better integrate their existing benefits with the proposed plan. Potentially employers could that way pay discounted levies in return for accepting responsibility for the payment of those claims. We also believe that the levies should be experience rated rather than the flat rate, so that employers with a better track record aren't subsidising those with history of high displacement or sickness amongst employees. We're looking to provide a submission to MB, which is due by the 26th of April, and we would really welcome the opportunity to discuss with employers what the proposals may mean for them. So now on that, I'll hand over to Jono, who will just provide you with some cyber market insights.
Great, thanks, Phil. Kia ora everyone, John O'Su here, Head of Cyber Specialty, and today I'll be giving you an overview of how the cyber market has been impacted heavily over the past 12 months and provide some commentary on where we might be heading in 2022. So 2021 was a very challenging period in the cyber risk landscape with the impacts of persistent threats, security challenges, and widespread changes to the way businesses operate as the lines between real and digital increasingly blur. And as detailed in this slide, 2021 was dominated by ransomware, digital supply chain risk, and global data regulations. So ransomware made all the headlines due to a massive uptick from 2019 onwards, creating concern industry-wide. We very quickly saw ransoms being paid in days and weeks, creating a short-tail loss event. Now, these demands themselves increased significantly off the back of the sophistication of hackers infiltrating valuable data and leading insurers to proactively monitor the performance of their cyber portfolio as the severity of the claims increased. Another major concern and challenge for insurers is the systemic nature of cyber risk now, which is driving a full review pertaining to their aggregation. So I liken this to having a multitude of businesses and networks all lying on the same digital fault line, to use a property analogy. So one vulnerability or piece of malware can affect thousands of organizations around the world in a heartbeat. And lastly, we have privacy legislation tightened globally, with some large fines now being handed down in jurisdictions such as Europe and the US, with it being only a matter of time locally, with New Zealand now also building out its legislative framework around data privacy. Thank you, Stevie. So what does this mean in terms of the cyber market for 2022? As you can see, it's all red in the ledger, with everything at the moment, unfortunately, moving towards the insurer's favour. As many of you will be aware, the cyber insurance market continues to reel from major cyber attacks, driving up both rates and the barrier to entry for insurance while constricting limits and coverage. The market is constrained by the carrier side, while clients are still essentially looking for higher limits or even exploring terms for the first time. So we're therefore experiencing a huge supply shortage rather than a drop in demand. In Q4, we saw premiums increase around 100% on renewals, while pressure on deductibles and in some instances limits decreased due to reduced appetite as insurers begun restricting total exposed limits and ransomware coverage. As of now, we have not yet been through even a full year cycle in terms of the hard market. Therefore, we do anticipate increases to continue to accelerate into the first half of the year, although there is some hope that by the second half of the year, we will in fact start to see them begin to pick back, barring a catastrophic global cyber event. So I do have to say that. In terms of the frequency and severity of claims, however, we have no doubt insurers predicted the frequency of events occurring. However, it is clear that the severity is something that took them by surprise in terms of what the costs actually were. So insurers are now revising their rating models to reflect this higher frequency and severity of claims, as well as modeling systemic events. So in essence, the actuarial process is improving as more data is becoming available. Which brings us lastly to the underwriting process, which has become more arduous with little flexibility from insurers who demand a full detailed cyber submission, including additional supplementary information before even considering a risk. Thank you, Stevie. So what are we doing about this at Marsh for our clients? We have worked closely with the global cyber market to understand their concerns and created a baseline of top cybersecurity controls detailed in this slide. These controls are the key to continued insurability, mitigation, and resilience, and really are an indication of controls that have failed and led to significant losses in the market. Hence why insurers are heavily scrutinizing these controls in order to quote business altogether, with the long-term outcome being a more sustainable and stable cyber insurance market. We are proactively working with clients well in advance of renewals and first-time placements to highlight any weaknesses and assist with improvements as needed. So this method is proving incredibly successful for our clients in order to not only prioritize their capital expenditure to prevent an incident from occurring altogether, but also achieve a more optimal outcome with the insurance market. Thanks, Stevie. So where to from here for the cyber market? While we don't have a crystal ball at this stage, there is a collective commitment from insurers, brokers, and reinsurers to create a sustainable market for what is now a top risk for all organizations. The light blue line signals factors that have contributed to a current state of the market that we're in, and where it might head if nothing changes. The green line, however, is the future that we want and the factors that can aid market stabilization. And this intends to be achieved by improved cyber hygiene, risk engineering, predictive modeling, active government regulation, and private and public partnerships. Both are options of an uncertain future, but we are working to steer our clients towards the green path. There are, of course, potentially significant ramifications to the cyber market as a result of the war in Ukraine. While it is at the moment far too early to tell how the market will respond, we do expect further vigilance and proactive management of their portfolios at this stage. Anything further right now is nothing more than mere speculation. Just some final comments. While there are still certain challenges ahead for cyber, what I really want to finish on is this. The reason the market is in a sharp corrective phase is because the cyber insurance product itself has responded and is proving to be paying very large claims, but just as importantly, providing critical value to our clients at this time of crisis. This should technically put to bed the myth that cyber insurance doesn't work, while we look to influence a market that is more transparent and accessible to our clients going forward. I'll now hand it back to Josh to lead the Q&A. Thanks, Josh.
Sorry, I was having some issues restarting my video. Look, thanks, John. I really appreciate it. And also thanks to all of the really great questions that we've had come through the Q&A. If we can't get to those in the system right now, I promise you that we'll respond to you with an email very shortly after the session. So look, I'd just like to use this as an opportunity now to quickly bring in Donald Gardner, who leads our construction specialty. I did just want to make sure that we address the construction insurance market. So Donald, we just have about sort of 7 minutes to go, but can you outline to the audience what sort of key changes that you're experiencing now within the construction insurance market? I think that would be a really good place to start.
Okay, well, like the property market, there are areas within New Zealand where capacity has been constrained, specifically the Greater Wellington region. But in terms of something that is specific to contract works, the insurers have for some time been pulling back on the additional amounts of cover. The core cover still remains and is available, but the width of cover and some of the traditionally more optional areas have been pulled back. And the main areas in that is around the scope of cover during the defects period. It's now what is called extended maintenance rather than guaranteed maintenance, which is a contraction of cover. And insurers are becoming more and more reluctant to provide a wider form of defects cover, which you may have heard of as Leg 3 or DE5, which are the specific wordings used to give the wider cover. That's something that insurers have been pulling back from, and within the next 12 months, it is possible we may not be able to get that wider defects cover. Even if some insurers are willing to give it on the larger projects, the ability of all co-insurers to provide it is going to be missing. We're also seeing insurers looking for higher deductibles, particularly on larger projects, and they're interested in how fire and water risks in particular are being managed. Those are the two main causes of loss and the leading value of loss between them. So that's where insurers are really starting to put more effort.
Thanks, Donald. Really appreciate it. Mark, I've got one here for you. I mean, we've spoken about the Ukrainian situation right now with Russia. I would anticipate that the marine market and marine risks and coverage are currently being impacted by what's going on between the Ukraine and Russia.
Yeah, you're right, Josh. Most cargo policies that are bought globally actually include an element of war risks cover in there. And what's actually happening is, and we're not seeing it so much in New Zealand at the moment, but at a global level, what's actually happening is that insurers are issuing notices of cancellation to remove war risks covered from the policies. And the policies allow them to do that. It gives them 7 days notice. So what we're seeing in New Zealand is that whilst there's not been a wholesale take-up of the cancellation notices by insurers, selected clients are getting targeted, and they're mainly getting targeted on the basis that insurers have looked at the risk profile for New Zealand and are looking at it and saying, what clients do we have an exposure to in terms of exports to Ukraine and Russia? And New Zealand's not a big exporter to that region. So they're looking at it and they're saying dairy and the horticultural industry have an exposure. So it's clients in that space that are getting notices of cancellation issued. The notices of cancellation only relate to war risks cover. So the client still has all other coverage intact within the policy. It is possible that for an additional premium, some clients may be able to buy back the war risks cover. It's likely to be very expensive. If you looked at the hull rates, for example, as a comparison, at the moment, if you were a vessel owner and you had a vessel sailing in the Black Sea and that vessel was calling at Russian ports, you may be paying a premium of 10% of the value of the vessel as a premium to cover the war risk. So it's not going to be cheap, but it is available.
Thanks, Mark. Look, I'm sorry, I missed most of your answer there. I had an unstable internet connection here in the office. It's kicked me off, but thankfully I was able to dial back in my phone. So hopefully that's still working. Hey, Jono, just sort of coming back to cyber, I read today some issues emerging in the US around the war exclusion and insurers' response in particular to the application of the war exclusion as it relates to cyber policy. So when we think about what's happening with Ukraine and Russia at the moment, do our clients need to be concerned about war exclusions within the cyber policies?
Yeah, thanks, Josh. And it is a question which is coming up quite a bit at the moment, as you can imagine. Look, we have obviously touched base with our colleagues across the world, and I think just to give a bit of context, it is, as I'm sure a lot of people would understand, it is an incredibly unprecedented situation. We didn't think we'd actually ever have to consider the reality of a war exclusion in terms of the cyber market, but here we are. So there is so much discussion at the moment. There are no legal precedents whatsoever, and a lot of it is really policy wordings. And really there's just a lot of speculation right now across the board. So I think the safest thing you can do is really to have a chat with your brokers, go through your wording specifically, and try to find as much clarity as possible without too much speculation. But really beyond that, I think it's really waiting to see something to potentially happen in that space first, and really seeing how those exclusions might actually play out in reality. But it is, as I said, an unprecedented situation, as we can all appreciate.
Thanks, Jono. Yeah, certainly a moving feast. Look, I think that brings the session to a close. I just wanted to thank all of the panelists who have joined me here today. Thanks to all of our clients and all of our colleagues as well who have dialed in. Apologies for the slight technical issue at the end, but hopefully you got a really good sense of the content regardless. If you do have any questions that you haven't yet had the chance to ask, please do get in contact with any of the panelists or indeed myself, and we'll make sure that we get a response back as soon as we can. Thanks, everyone, and have a great day, and look forward to seeing you all very soon.